Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips here, and got a special guest today. Going to get into a fun topic. I was asked to be on a show with friend of mine who has an investor group, not necessarily real estate, wanted us to come on and talk about, I don't know, the market and why real estate is now a good time to invest. Some of these basic questions, but conversation was really, really good. So I invited Brendan Seiber on to be on the show today and have that same conversation. Brendan is director of sales for my company, does a fantastic job. Man, he works with so many people and hears these questions all the time, and it's kind of fun to actually talk through this stuff. Brendan, we had a good time the other day. Welcome to the show, man.
Yeah, I appreciate you having me on.
So, first question I think they asked us was, why invest in real estate? And I rattle off this list. I think you have probably heard this out there. I don't know how many times I've actually been through this list, but I want to just go through it again because I was talking to one of my attorneys last night. And I was going through this list. She just kind of asked me a little bit about real estate. But anyway, there's no other investment where you can own 100% of the investment. I mean, you can, I guess, with stock, but man, you'd have to be, well, Elon Musk. You'd have to be able to buy all of the stock, right? You personally have to have the ability to affect the value of the stock or the investment. It has to provide both a high dividend and a high growth or appreciation. And it can be purchased on payments over 30 years at a fixed interest rate that someone else pays off for you while having massive tax benefits. And by the way, you have to be able to have an independent valuation to ensure you're not overpaying for it. I mean, Brendan, do you know anything like that?
I haven't heard of one.
No, I mean, I don't think there's anything like that out in the marketplace other than real estate. That's why real estate is so fantastic. It's only one of the reasons. But then we moved into this conversation, Brendan, and we started to chat a little bit about interest rates. And because interest rates are so high, is now a good time to invest in real estate. What are your thoughts on that?
Yeah, that's going to be one of the most common kind of concerns we get with not only new investors who are just looking to get into real estate, but people who have invested for years and own several properties through different stages of the market over the past decade. I mean, a lot of people are asking that when they come and talk to one of our consultants. Is now a good time to invest with interest rates as high as they are? And it definitely creates kind of a unique situation where most of the successful investment properties on the residential side are kind of those starter homes, those lower priced for the area, single family residences that not only appeal to tenants and investors who are looking to cash flow, they also appeal to the biggest group of home buyers in the country. And that's the people looking for a kind of starter home or that middle class home. And those buyers have watched over the past 18 and now probably closing in on 24 months. They've just watched their buying power get sapped. So a lot more people are holding down their sub 3.5% interest rates. They're holding off the move. They're continuing to rent. So when you can find a property that does cash flow and give you a modest dividend or cash on cash return, and it does so with a 6.5%, 7.5%, 8% interest rate, it leaves a whole lot of upside on the table, both for a potential refinance if interest rates happen to go down in the next few years. So you can walk into some serious cash flow without having to do anything to improve the property or raise rents on your tenant. On the other side of that coin, if interest rates go down and that biggest pool of buyers in the country start shopping again, you can see the most instantaneous equity growth in a very short amount of time.
Yeah, and I think people maybe don't remember, but that's what happened. We had COVID. Everybody was stuck in their houses. Nobody could shop for real estate. And then as soon as the gates were opened again, prices shot up through the roof because there was this pent up demand. Well, we have another pent up demand. It's not because of COVID. It's not because of anything like that. It's because people can't afford the properties, and that increases the renter pool out there. In addition, and rents most likely will either stay where they are or they're going to continue to creep up as inflation pushes everything more expensive. And the other really cool thing I think that we talked about too was, builders right now and sellers right now are giving incentives to move their properties. Some of these incentives are pretty they're pretty good. In essence, you're buying below market right now with the potential upside that you were just talking about, Brendan, if the interest rates actually come down, which I'm not sure that they will in the near term or even the medium term. But if they do, for whatever reason, the prices are gonna go up. There's gonna be a massive equity gain. So I think perhaps people got spoiled back in the day that with the cash flow, but I think people need to remember that most of the actual money or wealth that is created through real estate is created through the equity spread that comes from paying down the principal on a mortgage and the appreciation that happens over time.
Yeah, absolutely. And that's why a lot of times investors coming in might get hung up on a specific dollar amount, cash flow value that they read online, or some forum told them they need to target. And people will look at that and they might overpay for a property just to hit that, let's say, $500 cash flow number. But that $500 in cash flow doesn't make you wealthy. The other three rates of return in combination, through years of investing and compounding your returns, generate wealth. So you have to ask yourself, what's more important? Hitting the in the park home run on every deal, or actually achieving those long term financial goals.
Well, and I love the forums that quote a specific like cash flow number. Like you shouldn't buy anything unless the cash flow is $300 or $400 or $500 a month, which takes nothing else into consideration other than just the cash flow number. I mean, I can make any property cash flow that number if you want to. I mean, it's not that hard. You just put more money down, or you can just go buy a more expensive property. The cash flow is a little bit more, but that eliminates the return on investment portion, which is far more important than what the actual cash flow number is. Unless you're in your end of life and you're like, hey, look, I need $5,000 a month, $10,000 a month cash flow. And then in those situations, we're trading equity for cash flow, right? But we should still go after as high of return as we can possibly get, not just some cash flow number. I find it amusing, but we see that a lot. We also see people with these dumb rules. 1% rule. Like I have to buy on the 1% rule. Well, do we have to buy on the 1% rule? And what is the 1% rule meant to do? What is it actually that it's meant to do? It's just a gauge of how decent a property is out of the gate. That doesn't mean that you shouldn't look a little deeper into.
Yeah, yeah, and it's kind of interesting. A lot of times when you hear people looking for that arbitrary 1% rule, it also happens to be in markets where even if it hit that, they really wouldn't find a property or a deal that would kind of check all their boxes as far as the return, because you have to take into account things like insurance cost, county and city taxes in these areas, where some of the more affordable markets that even we sell property in, the rent could be a 0.75 rule, and the property could far outperform something in a less affordable city, less landlord friendly, less tax friendly city that has that 1% rule all day.
Hmm. Yeah, there's so many other things to take into consideration. It's funny. Some of these questions, and one of the fun questions I think we talked about was how do we actually vet properties? Like how do we go out there and look as we start talking through these rules, and what areas we invest in. Brendan, let's talk through like how do we actually vet areas and properties and everything? Like what goes into what's the kind of the inner workings of vetting all of that?
Yeah. So that's a really good question, and definitely when we start working with investors, that's one we hear in just about every transaction is right. Where did these properties come from? Where are you in these specific markets? And first and foremost, what we look at is, of course, landlord-friendly states and cities. So legislation's not going to get in the way of your success because at some point in your investing career, there's going to be something you're going to have to deal with. A tenant might move out early, not pay, and you're going to have to deal with it. It's a fact of investing. It's one of the two major risks in regards to real estate. So we just don't target states or cities that are going to set you up for failure right out of the gate. Past that, another big piece of it is the property management relationships. So most of our selling relationships and our kind of backside property management relationships come on referral business. So Ron's been in the game for since 2005 now. So
Mm-hmm.
in most of the markets that we invest in, just like the investors we work with, we're able to get great referrals to other builders, developers, and management companies, so that we can work with people we know and have confidence in their product. Not to say that that can't change over time, because it does. And having constant communication with our investors lets us get ahead of those things when it does happen. But from there, we have a good baseline for a market that we can confidently invest in, and then it's just a matter of finding builders and rehabbers who can abide by our process. And we were actually talking. We were asked about how often a builder or rehabber that doesn't do a good job slips through the cracks, and we were thinking about it, and it's pretty rare. And we kind of attribute that just to our escrow or due diligence process that we require our sellers to abide by. So we have them sign an agreement that says that for every transaction, specifically renovated properties, there's no negotiation back and forth. We ask that the sellers repair every item from the summary page of the inspection, or we cancel the deal. And just that alone pretty much thins out anyone that wouldn't be confident in the work and the property that they're providing. We
Mm-hmm.
really don't have many issues from a property standpoint past that.
So we move into like what are the risks in real estate, right? Well, the biggest risks in real estate come from the most important piece of making this work, which is the tenant. You need one in your
Yeah.
property. They're also the biggest cause of problems, right? Maintenance and vacancy are your biggest cost. They're your largest risk. And I love the fact that we do this in states where they don't necessarily have the upper hand. And that's really, really important because it mitigates a little bit of the risk that comes from them. But vacancy and maintenance, those are really they're the biggest risks, and both of those can be mitigated too. It's really simple. It's a math equation. If your property is vacant for a month and your rent is, say, $1,200, that means that you could lower the rent by $100 if you're vacant for 1 month. So if I could have a tenant today that would pay me $1,100, it's better than it's equal to a tenant that will pay me $1,200 next month. Now, if I let it sit there for 2 months, it's the equivalent of $200 a month. I could have rented it for $1,000 today. All right, so it's just a math equation. That's really, really important to keep in mind because people get stuck on rent, this high rent amount, and if you get stuck on this high rent amount, your property can sit vacant and you're stepping over dollar bills to pick up nickels. It's really, really unfortunate. That's one of the biggest risks. And then the second risk is maintenance and repairs when your tenants move out. And that's why screening is so important. And you can't eliminate those risks, but you can certainly mitigate those risks, for sure. Those are the biggest risks I think in real estate. Anything that you couldn't insure against, and you can actually insure against vacancy as well. I think just most people don't use that part of their insurance policy. So let's talk a little bit about where we see the real estate market going in 2024. I don't know what your thoughts are on this, Brendan. We talked a little bit about real estate or on the interest rates in real estate this year. We just had the Fed keep interest rates the same, nothing changed, even though they said they were going to go down. I think that's because what I've been saying on the show, everybody, like that we still have a problem with inflation. Doesn't matter what the government is telling us, there's still a problem. If we didn't have a problem with inflation, they probably would have brought the interest rates down. So I don't think they're going to come down. But interestingly enough, the real estate market is still increasing. I think it will do that for the balance of 2024. Brendan, any thoughts on the real estate market?
Yeah, I definitely agree with that. I mean, anybody who goes to the store and has to pay their bills can still feel that inflation's extremely prevalent. So I definitely don't see interest rates going anywhere in the short term. I know we talked about some of the benefits should interest rates go down earlier in the show, but it actually, like you were saying, with the builders and rehabbers throwing incentives at the deals right now because they've been in business long enough and they understand the importance, the speed of money, continually doing deals, despite the market and understanding that profit per deal kind of ebbs and flows, but consistently providing product for them and selling to investors is far more important than trying to maximize their profit on say one flip or one spec build. So should interest rates continue to stay the same, which they've been hovering pretty consistently, up and down 0.5% over the past couple months. Should they stay the same or continue to go up? We're hedging against inflation with some of these seller paid buy downs. I mean, I know just a couple months ago you had Aaron Chapman on the show, and he's helping investors really hedge with 5.5% interest rates on a builder buy down,
which is
insane. So there's some great opportunity out there right now.
And those are on investment properties, folks. Like 5.5 on investment properties, ridiculous. It's ridiculous. Because right now, I think investor rates, Brendan, aren't they above 8?
Yeah, they're around 8.
No buy down. That's 3% drop. It's insane. Well, listen, I think that the real estate market is going to continue to inch north. I don't think it's going to drop, and I don't see that it has flattened in most markets. And of course, guys, we're talking nationally, right? And real estate is not national. I've said it a million times. It's local. So you could be saying, well, it is here where I live. It's flattening out. And that may be true. Most of the markets we're in, the real estate is still tracking north, but not by a ton. Things have slowed down dramatically. And I think that's going to continue through the balance of the year. And then we'll see what happens in 2025 and what happens with building permits. We'll see what happens with the prices to build properties. Right now, it's still expensive to build. So, I mean, it's not like builders can build something less expensive. They literally can't do it. So prices can't come down on new construction, and we don't have that much of a supply of existing homes because what Brendan said earlier, the people are keeping their 3.5% interest rate. So we have this problem in the market right now, and something is going to have to change. Some lever is going to have to move in order for anything to change more than it is right now. So is now a good time to invest in real estate? The answer to that question is it's always a good time to invest in real estate. You just have to watch the numbers. You just have to make sure that you're making a solid investment. It doesn't matter whether it's now or whether it's 4 years from now or 4 years ago. Best time to plant a tree was 50 years ago, and the next best time to plant a tree is today. And on that happy note, Brendan, thank you for joining us and bringing your educational mind to help everybody else on the show. Appreciate it.
Yeah, absolutely.
Till next week, everybody, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.